Please subscribe, like, and hit that notification bell. Thanks, guys.
Kevin, the comics is out of silver, man. It's out of silver. It's the price I have to go up now.
All hell's breaking loose, Pat. It's silver to the moon.
Oh man, Jesus. But this is the thing there, like, guys, I know a lot of guys follow the fundamentals, the comics, the supply, all that, but seriously, that's just news narratives fit on price action. Because what would have been the excuse if silver would have been going down today? Nothing changed at the comics, like, so you got to be careful to not trade. Look, I'll phrase it this way, Kevin. You could have all the news and try it could fit and match, but seriously, in a trading framework, how do you define sell stops, entries, exits based on these like fundamental type news? It's practically impossible unless you know how to do it.
No, I'm a man of science, Pat. You know me. Show me a graph, show me a chart, and I can point to something that amounts to evidence. But yeah, I mean, these stories are great. They're interesting, and sometimes they line up with what the chart does. Sometimes they don't. As you say, there's always a story to be spun. I've shown that many times, that the chart is there telling you what's going to happen before the news story appears. I mean, the invasion of Ukraine by Russia was a good example of that, and the charts were already saying what was going to happen at that point in time. Talking about energy prices, the narrative is that energy prices are high because of the war that broke out. Well, that's not true, because the charts broke out before the war started. So come back to me with a new narrative, please, because that one just isn't. That one is demonstrably false. So yeah, I mean, we've been looking at the charts this morning. I mean, clearly there's some big moves today, not least in the cryptocurrencies, but we're looking at precious metals. And one of the things I noticed, apart from the fact that silver has made a big move today, is that the gold to silver ratio is starting to break down as well. So we started looking at the charts individually. Pat's got the gold chart up here, and we're just trying to make some kind of sense of where we're at, really, looking at the big picture. I mean, this is a very very, very big picture chart, and just trying to put into context where we've been, where we are now, and where we might be going.
That's right. Look, no matter what the news is, this is a semestrial candle chart. So each of these candles, it condenses 6 months of price action. So all that volatility, all those news, anything 6 months is a lot. It's a lot of economic data. It's a whole bunch of stuff. And then I fit a 6-year moving average. And when the price trends above it, meaning in a meaningful way, eventually there's a retest. And then you wait. You see, even here on the smaller timeframes, it dipped below, but then closed a month above. Then after that, off it went. Here, just grinding sideways, up and below, nothing. Could have been a trend line here. But once it closed above and kept closing above, then you're starting to build a meaningful trend. And today, we're wondering why gold is bouncing, what's happening. Well, it's starting to react to two things: the moving average, long-term meaningful support, and also a wall. So in 2012 or 13, gold never had a semestrial close above 1670. So if you want to look at the big picture, what's gold's high on a semestrial basis close? It's never closed below 1670. But what that tells you also, that is critical resistance. But once we closed above it back in 2020, that became support. And the only thing that we've been doing for the past couple of years is we've been retesting that support. It did it here. And right now we're dipping below, but that chart I did a few days ago, right now of today's price action, is gold above 1670? Yeah, it is, right? At 1677 today. So gold's reacting to this confluence of support right below it. And if you don't want to get bamboozled, whipsawed, and everything, like gold's going down to 1300, gold's going down to 1100. Step number one, gold has to close on a semestrial close below that line. Then you could say, oh, okay, the doors are open to a more meaningful waterfall decline. But until we close the end of the year below 1670, for me, all that's happening right now is noise.
Should just say that these 6-month candle charts are the first 6 months of the year and the second 6 months of the year. So the first, you have January to June, and then you have July to December. So we're in the July to December 6-month candle at the moment. So what we're looking for is the close at the end of December. is what's going to define that. So 1670 is the number you're looking for at the end of December. Above that, all good. Below that, yeah, not so
That's right.
much.
And we're so close. We're November, guys. There's only 2 months to go, and we'll know the truth. Gold is going to show its true colors. The market's going to show where it wants to go, depending on gold's close by the end of the year.
Yeah,
Do
and
you see this one, Kevin?
Yeah. I don't like the bad zone there, Pat. The bad zone's not good.
Well, I had to draw them because I could
Yeah,
have. Whenever the price is below, let's say even the 3-year moving average, or below what we call sleep mode lines, below the 1-year moving average, that's when, if you keep having higher and higher up targets when you're below those lines, it's kind of hopium. You're not on the good side of the trend. It could very well continue upwards, but you could also grind sideways. And as the recent price action has shown us, you could actually dip. So right here, the price action, we're still below this wake up line. I don't even know where that wake up line is, guys, because to have a true wake up line, you need multiple touches on it, right? You need 3 bounces on the line for it to morph into existence, just like we did here back in 2013. 1 touch, 2, the 3rd touch, like it was all the way back in 2015. Then when you close above, you know that was a meaningful wake up breakout. So this one, I'm not quite sure where it is, but usually it's aligned with the 12-month moving average. So 12-month moving average is,
what I was going to say, what we're going to find out soon, if we've got a decent bounce going on here, we'll get another pivot line for that wake up line. So if we
yes.
have a decent bounce and it turns back down, then we know where the wake up line is going to sit. Of course, you know that what we're all hoping for is that this just powers on upwards and slices through horizontal resistance above the cloud and back above the 3-year moving average, and then things start to look a lot more hopeful again. I think that 3-year moving average is pretty important because getting back above it will put us back into a much more bullish sort of outlook. So this is sort of looking at a slightly shorter term view than the previous chart Pat showed there, and it just shows how you can kind of take a broad view looking from a distance and getting a big picture view of just how bad things are in the very long term, as opposed to getting some earlier signs that things are starting to turn around. As exciting as this move is over the last few hours, it means nothing until we get some meaningful monthly closes above important points.
That's right. Here, look, there's an inside month. Here, this could be a bullish engulfing. I just noticed that it opened below the previous close, and now if it closes the month above the open of that previous month candle, that's a bullish engulfing. Very bullish. It's the cloud is doing its thing. It's holding the support. So now you have the support of the cloud, but you have the overbearing resistance of that 3-year moving average. So there's a high chance that we rally all the way up to 1784. Then we'll know the truth. We'll know the truth. But these are monthly candles. That's December. That's January. Then after that, it could do a pull flag here a few months. Guys, before we go back to all-time highs, we could be in mid 2023. Seriously, unless you're like you think you're going to do a V shape, it could be all the way to 2023 before we even come and retest that breakout line. But this is the bullish part of it, guys, because this now will have created a much bigger launch pad. We're going to have a launch pad that's going to be in length, if ever. So let's say this is the launch pad. It's going to be the same size as the launch pad we had from 2016 all the way to 2019, which created a move that brought gold from 1,300 all the way above 2,000. This is what we're creating, guys, a beautiful launch pad. And then this will probably support properly a strong and fast move all the way up to 3,000. So if you want to know a setup that's going to support a move to 3,000 for gold in US dollars, this is it, guys. We could be witnessing it right now.
Also remember that move from $1,300 to $2,000 that Pat just mentioned, the whole time that move unfolded, that $800 move, gold was not outperforming the stock market. Okay. Now, if the breakout occurs here and gold breaks out versus the SPX, then it's my personal view that gold will move a lot more than $800. And you can look at the period from the year 2000 to the year 2011 to look at something that might be comparable, and that was a move of gold moved by a factor of 8 from $250 to $2,000. So when you talk about upside targets, I would agree that somewhere between 2.5 and 3,000 is the initial target. But if gold has broken out versus SPX, then my target is $10,000 plus. And that might sound ridiculous, but it's, in fact, if we move to $10,000, that would be a smaller move than we, percentage wise, smaller move than we made between 2000 and 2011. So, and to get that to get that kind of a move, you need a big base. That's why this is so frustrating. It's so annoying. People are getting tired of it. Precious metals are a waste of time. It's exactly what we need. That's exactly the sentiment that we need to have if you're wanting gold to move to those sorts of values. If you're wanting to see the miners return, hundreds or even thousands of percent, profits, it's not going to happen with a tiny launch pad. Like Pat said, you need these big launch pads to launch these big moves. Without a big launch pad, you don't get the big move. And in fact, that whole period that Pat's just highlighted from 2011 to today is effectively a launch pad. We still haven't broken out, above that $2,000 level. We've been fluctuating between $1,500 and $2,000 since 2009. In fact, we've been trapped in that sideways range. So something big, in my view, is building. And it's frustrating. I appreciate how frustrating it is, but you're not going to get that big move without that huge consolidation period.
Very well said. And guys, just to close, to highlight what Kevin was talking about, look here at my screen. While U.S. equities are going up, precious metals are going up higher. And remember, back in the days, I was looking at gold to SPX ratio, and Kevin also. Even if gold was going down, it was going down less fast than SPX. That was step one. And now what we're witnessing is actually step two, is the ratio is still going down, or it's going up in favor of gold, but now with gold going up. So this is showing you even if you think US equities are going up, they're showing a lot of teeth. This is actually weakness because they're not able to go up as fast as precious metals. So now capital flows are coming back into the markets or leaving the DXY, wherever they're coming from. But they're favoring now they're coming back in the markets, but they're saying, I'm not going to go as much in US growth stocks as I was before. I'm coming back, but this time I'm coming back in precious metals. And that's exactly the gold silver ratio. What it's telling you, that is exactly what let's pop up where is here. Remove drawings. That's where we are today, guys. And just this move here, Kevin, remember that's that move from 2019 all the way up here. That was gold going up $800, right? But it still hadn't broken out. It was just a bear market rally, right? It didn't even get out of the cloud. That was a bear market rally for gold versus SPX. So right now, if gold can get back out above the zone, .48, .50, man, we've done this chart a lot of times there. This is where you get a reverse symmetry move of massive outperformance of gold versus SPX. So while SPX could be going up and you nominally feel good because your 401k plan and your pension fund looks not bad because you have a lot of US equity stocks, traders, the people who would be in the precious metals, they're going to get more return, more wealth preservation once gold breaks out versus SPX.
And that is the key. Once gold breaks out versus SPX. So, we're not saying for a moment that that's going to happen imminently. We're not trying to suggest it's going to happen in the next week, the next month, or the next 6 months. All we're saying is that when it happens, that's when you want to take notice. And it's the target that Pat just showed and the move that Pat just showed that has to be activated. And the key point that a lot of people miss when they see us putting charts like this on Twitter, they assume that we're saying it's going to happen, next week or the week after. No, that is not the case. What we're saying is that when it's activated by crossing that line, that's when you want to really pay attention and start, looking seriously at the precious metals market and taking positions, knowing where that line is. This is what technical analysis is all about. Knowing where that breakout line is key to all of this. You don't need to fear of missing out. You don't need to FOMO. You wait until you get the breakout evidence, and even better, wait until it back tests that breakout line just to confirm what you suspect is happening, and then off you go to the races. Everyone's a winner, and you look like a genius. So knowing where those lines are on the chart, where those critical lines in the sand are, so important.
Couldn't have said it better, Kevin. And that's why I'm starting to put the hashtag patience in my tweets, because we're not there for bragging rights of catching the bottom. In hindsight, once we get those breakouts, our roadmaps, people will say, "Oh yeah, look, that was actually the bottom we had now, hitting that 8-year or 6-year." Fine. But as a trader, there's no, if it's somebody tells you buy here when it's still plummeting, it hasn't broken out through anything, I wouldn't listen to that at all, because they're telling you catch a falling knife. So of course, in hindsight, oh yeah, that guy called the bottom. But as a trader, could you have really played that? And in a safe manner, in a professional manner? I don't think so. You need to wait for confirmation to enact those targets to avoid opportunity costs. That's the way we do it.
100%. That's it, Pat.
All right. Thanks, guys, for watching.
Cheers, guys. Next time.
Bye.
Please subscribe, like, and hit that notification bell. Thanks, guys.